Walgreens Boots Alliance, a company with a legacy spanning over a century, is in an increasingly precarious position. Once a dominant force in the retail pharmacy sector, Walgreens has struggled to keep up with the rapid changes that are reshaping the industry. While it remains one of the most recognized pharmacy brands in the United States and internationally, its business model is being challenged on multiple fronts. From growing competition in digital healthcare to rising operational costs and shifting consumer behaviors, Walgreens has had a tough time maintaining its market share and profitability. The company has faced a sharp financial decline in recent years. In its fiscal year 2024, Walgreens reported total sales of $147.7 billion, a 6.2% increase from the previous year. However, a closer look at the numbers reveals deeper problems. The company's operating loss surged to $14.1 billion, more than double the previous year's loss. This massive increase was largely due to a $12.4 billion non-cash impairment charge related to its investment in VillageMD, an attempt to expand its role in healthcare that has not yielded the expected results. Additionally, the net loss attributable to Walgreens was $8.6 billion, marking an alarming 180.4% increase from the prior year. This kind of financial distress is not sustainable, and it has prompted significant concerns among investors, customers, and industry experts alike. Competition is one of the biggest challenges Walgreens faces. While it was once a leader in convenient pharmacy services, the landscape has shifted dramatically. Traditional rivals like CVS Health have aggressively expanded their offerings beyond just filling prescriptions. CVS has integrated health insurance through its acquisition of Aetna and is developing health hubs, which provide a broader range of medical services under one roof. These initiatives make CVS a much more comprehensive healthcare provider than Walgreens, giving customers more reasons to choose CVS over its competitors. Retail giants like Walmart and Target have also strengthened their pharmacy businesses. Walmart, in particular, has leveraged its extensive footprint and competitive pricing to attract more pharmacy customers. With its reputation for low-cost goods and a growing network of in-store healthcare clinics, Walmart has become a strong alternative to Walgreens for many customers. Target, now under the ownership of CVS for its pharmacy operations, has also streamlined its services, making prescription pickups more convenient for shoppers already visiting their stores for groceries and household items. Perhaps the biggest disruptor of all is Amazon. The tech giant entered the pharmacy business with Amazon Pharmacy, which allows customers to order prescriptions online and have them delivered directly to their homes. This model challenges the traditional brick-and-mortar pharmacy experience, making it more convenient for consumers who prefer digital services. Amazon also introduced RX Pass, a subscription-based medication plan that provides unlimited prescriptions for a flat monthly fee. This kind of pricing structure is difficult for Walgreens to compete with, especially given its reliance on in-store sales and traditional prescription fulfillment. The rapid shift toward digital healthcare is another significant factor in Walgreens' struggles. The COVID-19 pandemic accelerated the adoption of telehealth services, and many consumers have stuck with these new habits even after the pandemic subsided. More people are opting for virtual doctor visits, digital prescription services, and mail-order medications. Walgreens has attempted to keep up with this shift by investing in digital pharmacy initiatives and telehealth platforms, but it has lagged behind competitors who moved faster and more effectively in this space. The company's traditional business model, which depends heavily on foot traffic to its physical stores, has proven to be a disadvantage in an increasingly digital world. In response to these mounting challenges, Walgreens has taken aggressive cost-cutting measures. One of the most significant has been the closure of several store locations across the US and the UK. While these closures help reduce operational expenses, they also raise concerns about long-term sustainability. Many customers, particularly those in underserved areas, have relied on Walgreens as their primary pharmacy. Closing stores may push these customers to switch to competitors like CVS, Walmart, or Amazon's online services. Debt has also become a growing concern for Walgreens. The company has taken on significant financial burdens, leading to questions about its long-term viability. With rising interest rates and a challenging retail environment, the cost of servicing this debt has become a major issue. Credit rating agencies have already indicated that Walgreens' financial outlook is worsening, making it more difficult and expensive for the company to borrow money in the future. The recent acquisition of Walgreens Boots Alliance by Sycamore Partners for approximately $10 billion marks a critical turning point. Private equity firms like Sycamore are known for implementing aggressive restructuring strategies to improve profitability. In many cases, this involves cutting costs, streamlining operations, and potentially selling off parts of the business that are underperforming. For Walgreens, this acquisition could mean even more store closures, job cuts, and strategic shifts in how the company operates. One of the biggest questions surrounding the acquisition is what will happen to Boots, Walgreens' UK-based pharmacy chain. Boots has been facing similar struggles, with underinvestment and store closures raising concerns about its future. Analysts speculate that Sycamore Partners may choose to sell off Boots to focus more on Walgreens' US operations. If this happens, it could reshape the pharmacy market in the UK, leaving customers and employees uncertain about what comes next. The challenges Walgreens faces are not unique to its own brand, but are part of a larger trend affecting the entire retail pharmacy industry. Inflation, rising labor costs, and declining insurance reimbursements have put pressure on profit margins. Many pharmacy chains have been forced to adapt by reducing store sizes, investing in automation, and shifting towards digital healthcare services. Companies like CVS are experimenting with smaller store formats that require fewer employees and lower overhead costs. Others are focusing more on home delivery and subscription-based medication plans to appeal to modern consumers. Despite these struggles, Walgreens remains a key player in the healthcare sector. The company operates approximately 12,500 locations across the US, Europe, and Latin America, serving millions of customers every day. It employs around 311,000 people and owns consumer brands including Walgreens, Boots, Duane Reade, Number 7 Beauty Company, and Benavides. This vast network and brand recognition give Walgreens the potential to reinvent itself if it can successfully navigate the industry's changes. Digital transformation is another critical area that Walgreens needs to prioritize. Consumers are increasingly turning to online platforms for everything from shopping to medical consultations. If Walgreens can invest more in its digital infrastructure and compete with Amazon and CVS in the online pharmacy space, it could regain some of the market share it has lost in recent years. This would require significant investment in technology, logistics, and customer experience, but it could be the key to long-term survival. Despite these opportunities, the road ahead for Walgreens is uncertain. The acquisition by Sycamore Partners signals a major shift in strategy, but whether that shift leads to growth or further decline remains to be seen. Many analysts believe that drastic changes are necessary for Walgreens to remain relevant in an increasingly competitive landscape. The next few years will be crucial in determining whether the company can adapt to the evolving market or if it will continue to lose ground to competitors. For customers, Walgreens stores remain open for now, but changes are likely coming. Some locations may see increased automation, fewer employees, or expanded digital services. For employees, job security is uncertain as Sycamore evaluates cost-cutting measures. For investors, the transition to private ownership means Walgreens will no longer be publicly traded, and future business strategies will be shaped behind closed doors. The bottom line is that Walgreens is facing one of the toughest challenges in its history. Its ability to compete in a world increasingly dominated by digital healthcare and retail giants will determine its future. The next chapter in Walgreens' story is being written right now, and only time will tell whether it emerges stronger or continues to decline. What do you think about Walgreens' struggles? Do you believe it can make a comeback, or is this the beginning of the end for one of the most recognizable names in pharmacy? Share your thoughts in the comments. If you found this analysis insightful, be sure to like, share, and subscribe for more deep dives into the world of business and finance. Thanks for watching, and I'll see you in the next video.